From the morning reading, the U.S. market reopened after a 3-day Easter weekend, but the equity trade spent the session in the doldrums. The benchmark S&P 500 logged its smallest intraday trading range of the year from its 0.2% morning low to its 0.3% mid-afternoon high. During the final 2 hours, the index bounced off the flat line a couple times before reaching its fractional 0.05% closing gain. The yield on the 2-year note closed at 1.89%, down 2 basis points from the previous close. Volatility in the S&P 500 has collapsed. Over the past 10 days, the index has moved at an annualized rate of only 6%, a glacial pace lasting nearly a year ago. At the same time, the VIX index suggests that traders are pricing in movement more than twice as high. Prior instances don't shed much light on whether those traders are most likely to be correct in betting on an uptick in movement. Small traders are not buying into this rally. Over the past 8 weeks, they've spent little more on speculative call options than they have on protective put options. The only other times that's happened to this degree were near the ends of the bear markets of 2002 and 2008, and again last October. And give me just a second here. There we go. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:57 a.m. Central Time, and I'm recording this in preparation for the market day of March the 29th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into our morning report. Little bit of weakness, nothing to get too excited about. The time of this cut, the S&P futures are down a little over 5 points, or about 1/4%. Russell futures are down a bit more, about 1/3%. NASDAQ was down just marginally, and the Dow futures were down about 1/3%. Crude oil was a big mover in the overnight, down 1.85%. Euro essentially scratch. Bonds just above scratch, and gold just above scratch as well. In overseas action, all of our market participants seem to be back online now. China was down 1.29%, Hong Kong just above scratch, Japan just below scratch, Germany down about 1/4%, United Kingdom down just below scratch. In terms of macroeconomic reports for this next couple days for the U.S., you have consumer confidence, you have Fed Chair Yellen speaking, and then looking forward towards tomorrow, you have the ADP non-farm employment change. The regular weekly crude oil inventories are both online. In terms of our current market conditions, you heard from one of the morning reading authors about the very low volatility, and we certainly are reflecting this in our own metrics here. Look at skew. It's a little bit elevated, just above the kind of warning threshold of 125. Not yet terribly dangerous by any means. Short-term VIX did move up a little bit yesterday to a 14.07, but look at these IV percentiles: 17 for the S&P, 21 for the Russell, NASDAQ 18, Dow 11. Most remarkable is how we track the standard deviation moves over the prior 2 trading weeks of time in a rolling basis. So you got here, this is -1 day, -2 day, -10 days down here at the bottom. Well, look at this. On the S&P, not a single standard deviation move in the last 2 weeks of trading. That is exceptionally uncommon, especially outside of, say, summer doldrums or the week at Christmas to New Year's or something like that. So for this time of year, to have 0, I think, is some note. Notice also that the NASDAQ and the Dow also exceptionally low. Russell's had a little bit more volatility, but it usually does. So very interesting conditions going on there. Let's go ahead and take a look at the charts. And we'll start off with the S&P, and you see yesterday's action was basically just a little doji. Right now, of course, we've been discussing yesterday's session, is this just another bull flag and another in a long series of continuation patterns, or is this developing to something more? Right now, it's nothing more than a bull flag and an expectation that we will continue to break up. Others are pointing to a bigger picture of a topping pattern and a rolling over. So we've got to watch this area between here and where price is. A break of this 1970 area on the SPX chart would be pretty significant, especially if you start to come back down here into the cloud. Remember, the top of the cloud here represents a support area. Certainly we have this as the last swing support, and there's been an awful lot of volume in the past that took place in this general area here. So pretty important zone of support between 1970 and about 1945 to 1950. So about a 20-25 point range there where you'd have a zone of support. Mark that on your charts. Be aware of that. If we do come back down and visit this area, that would be very significant. In terms of the Dow, let's go there next. Very similar picture. NASDAQ. Remember, NASDAQ's been battling the weight of the biotechs. This has been relatively weaker. And generally, when we think of good, healthy bull markets, we think of these high beta areas as being very, very strong. That has not been in evidence to the same relative degree, though we also continue to credit, and we'll talk about this in the daily report, that we have seen a broadening of participation from just the defensive sectors to also these higher beta areas. They're still lagging. They're not making the same number of 52-week highs as the more defensive areas, such as Dow 30s, big dividend payers, utilities, and those kinds of companies. But it's still worth watching to see how this relative performance starts to heat up or fade. Another example of this, of course, is the rut, which was on fire going for a 4-week period with nearly a retracement, and then basically kind of ran out of oomph just about the time when you thought, okay, well, we've broken through all the obvious areas of resistance and we've broken out. And then at that very moment, that's when we seem to have stalled. We made another run up. Basically, at this point, it looks like a false breakout, and then that's then fallen back as well. So very interesting place we are in the markets right now. We seem to have run out of momentum on many of these various indices. The VIX not really giving us much of a sign. You note that the current, and this is VIX futures, so this includes today, right now is, under 18. It's been kind of chopping around at this area, but not truly breaking down any further as of yet. So also seems to be in something of a consolidation pattern. Bonds seem to be starting to perhaps rise up out of their consolidation zone. So often the bonds are the leader in telling us where the market's going to go. So we should pay particular attention to this. And we mentioned, I think yesterday, drawing a box around this area. And if we start to see this start to lift up out of this box, and especially if it clears the cloud, that probably is also happening at the same time that the equity market is making a more significant retracement. And then we'll look at gold last. Gold, not really telling us much. It's been kind of a disappointing retracement, I'm sure, for the gold bugs right here, that we had this breakdown. But since that breakdown, it's basically been in a sideways pattern. Hasn't really indicated too much about where it wants to go next, other than just kind of indecision with these kind of spinning top type bodies and the like that we have going on there. In terms of our daily report, let's go on over there. Not a lot of changes from yesterday. We're still phase 4. We can be in the phase 4 for extended periods of time during bullish markets, and this is a bullish price pattern, so that's good news there. In terms of our mechanical signal market timing elements. We have from IBD confirmed uptrend with an accumulation distribution score still remaining at a NASDAQ C-, S&P B-. GMI index retains its 5 out of 6, so that buy signal has been in place since early March. Decision point scoreboards, we now have a pretty decent stack between the short and the intermediate term across all the indices, waiting to see what wins out. Do we turn the long term into greens? Do we truly set into new swing highs? Or is this just a big bear market bounce, and we then see the short and intermediate term give way to the longer term more dominant expected pattern, and then eventually break down and these all actually turn red? To be yet determined. Position sizing opinions still in pretty good order, though. They're both set at 100% on both systems. Intermediate term market posture very strongly bullish across all 4 indices, and you see 3 of the 4 are up over 90 and Russell's just below 90. This is supported by a weak bullish sentiment line, so the expectations is that on the intermediate term that the bullish swings are longer and more pronounced than the bearish swings. In terms of the strength of the trend, continue to have this weak but significantly improving strength of bull trend. Intermediate term again, keep that in mind. Hedge warning status still 0+, normal with some elevated risk conditions. No changes in terms of the special opinions. Option income strategies, the VIX is still inside the acceptable window to initiate new positions for novice traders. Cover call strategies and put selling also currently acceptable for not just aggressive traders but novice traders. Consider a slightly more bullish than what we've talked about in recent weeks ratio of in the money and out of the money strikes, going with 2 in the money strikes for every 3 out of the money strikes, starting to lean a little bit more exposure, a little bit more delta positive. Same thing with the addition of this 2 to 3 ratio of low beta and high beta, putting into your mix of your portfolio for your covered calls a few more high beta than low beta positions at this point. So still a little defensive, but not as much so as we've been most of the recent weeks. In terms of those special warning conditions, you see the volatility ratio warning just barely closed just above the window yesterday, so that's still in place. We're looking for a close back under this window to say that this is fired, but that has not yet done that. Distribution day count at NASDAQ remains a 5. That's a warning status. The skew is just above 125. That's about a 9% probability of a 2 standard deviation move in the next 30 days. So starting to become a bit of a concern and warning status there. New highs, new lows, nothing to note there. This was a change for yesterday. We had coming into yesterday 3 of these as risk off, and the other 2 looking like they were rolling over. Well, they went into risk off status with yesterday's action. So all 5 of these key intermarket risk aversion indicators have now flagged as risk off. So we are starting to see, that tide change to where we're seeing a few more warnings coming in from some of these special areas to kind of tell us that things may be starting to deteriorate within that marketplace. Sentiment, we have short-term risk is now also turned into warning status at a 7. And then in terms of the individual ETFs that are particularly high, you have the LQD that is very, very high sentiment. So if you're in that market, watch for potential reversal patterns. On our fear and greed index, this actually came down a little bit. You notice yesterday was a 66 and a week ago was a 78. We'd actually come up here into this upper quadrant for a few days, but that started to ebb off a little bit now. People are starting to pay a little bit more attention to the potential of fearfulness and those various sentiment indicators. In terms of intermediate term market posture on specific indexes as well as ETFs and breakdowns, notice this is a long list here, and we have both defensive sectors as well as broad market sector components. We have high beta areas as well as low beta areas. So they're all participating at this point. We're not certainly got every single sector participating in an intermediate term bullish posture, but there is broad participation. So this is much broader than what we saw just a couple weeks ago. In terms of percent change after yesterday's action, you see of note, healthcare, energy, financials, and transportation were the ones that are in a weaker market posture, especially in that short to intermediate term. Healthcare, again, continues to be the one that's pummeled the most with that biotech component. But this is kind of a mix. You think about this. When you think about healthy bull markets, where's transportation's Dow theory? Where are the financials? Cannot have a good bull market without participation by the financials. Many people may have their political reasons to go after the banks and so forth, but ultimately, without the healthy bank, you have no healthy economy. Energy, of course, also been very much at front and center of late, and right now is decidedly quite neutral across all the time frames. So some very interesting takeouts from this to kind of keep in mind. In terms of percent change, you see while there were some sectors that had pretty healthy increases yesterday, nobody was exactly running away with it, nor were they exactly getting destroyed. The ones that were down were only down relatively marginally. You see the 5-day, these numbers for the most part relatively minor changes. 1 month, of course, has been very strong, so let's kind of keep that in mind. Our short to intermediate term is currently bullish, so keep that in mind. And that should pretty much do it for today. One of the things I did want to remind you about today is that when you're listening to this YouTube video, there's a couple tools available on that platform. You go to that little gear button, and when you do that, you can do a couple things. That little gear will let you access the settings. You can make sure that you're watching this in high definition, especially when we go to the charts and the like. It's much easier to see that with clarity when you are using the high definition playback. The other thing that you can do is you can cut this often about 20-minute video down to about 13 minutes in playback by running the video at 1.5x speed. You should be able to understand very easily what I'm still saying. You can hear me faster than I can talk, and yet at the same time, you cut down that speed for your morning preparations into the markets. So something to keep in mind there. Obviously, you can also subscribe to the channel. If you're finding that this is helpful to your trading, you'll get an alert when new content is posted by being a subscriber to the channel. There is no cost to subscribing to the YouTube channel. And we'll go ahead and just kind of scroll through the rest of these offerings at this point. If you see something you'd like to spend more time on, just hit the pause button, go to that hyperlink, and you'll get more and additional details. Disclaimers as always, hit the pause button if you need more time to review, and then you see the hyperlink at the bottom for the full set of disclosures. We'll see you back here tomorrow morning for the Falcon Global Market Preview. Good trading.